Good afternoon, everyone. We're just going to give it a minute as everybody is admitted in from the lobby. Usually takes a couple of seconds. But okay, looks like we've got a good group here so far. So I will just get started. Thank you for joining us. But before we do get started speaking and kind of diving into everything, if everyone can hear me, if you could just drop a note in the chat, that would be great. I just want to make sure that you can hear us either in the chat or the Q&A, either one. And we also want to make sure you can see my screen as well. Okay. Sam, can you see the chat?
Yes.
Okay. People can hear me. People can see me. And
Yes.
you? Okay. Great.
Yes.
So welcome to another Homebuyer Series webinar with the Theriault-Fazio team at Origin Point. My name is Joanne Theriault-Fazio. I'm an SVP of Mortgage Lending and Divisional Sales Director of Midwest for Origin Point, and I'm thrilled to be one of your hosts for today's session. Sam Fazio, SVP of Mortgage Lending, is also joining me as co-host. But before we dive into our topic for the day, which is first-time homebuyer programs, we want to introduce ourselves and our team for those of you who may be new here. We're a husband and wife team. We're based out of Chicagoland area, but we're personally licensed in 20 states. And we are just, licensed everywhere, making our expertise widespread. We've been in the mortgage real estate industry for multiple decades and have had the privilege to assist tens of thousands of borrowers. Our team is one of the top mortgage teams in the country because we surround ourselves with some of the best and brightest operations staff, some of whom have worked with us for 10 or 20 plus years. And we also believe that having the best platform is in the best interest of our clients and referral partners. We've been with rate companies for 18 years. Having Rate as our parent company means we are backed by one of the top lenders in the country with the absolute best and most consumer-friendly platform and all the amazing programs that we get to bring to our clients. Our goal is to make the home financing process as seamless as possible, and we take pride in being knowledgeable and accessible to our clients and referral partners. There are so many facets that go into qualifying a first-time home buyer, and we have an endless amount of products. We won't possibly get through them all, but here we're going to give you a little sneak peek at first-time homebuyer programs today. With that being said, we're going to talk about some programs, some down payment assistance. We're going to talk about our power bid programs and then our upcoming events that we have. Also, just a little bit of information about us here. I'm going to skip through that since I just talked about it, and I will kick it over to Sam to talk about renting versus owning.
Yes, let's definitely talk about renting versus owning. For those of you who are still out there renting, if you take a look at our chart, just to it's really there just to give you an idea of what you're spending over a course of, let's just say, 3 years while you're renting. So I would say average rent right now in most parts of the United States is somewhere around $2,000 a month. If you look at a 3-year period, that's going to cost you about $72,000, of which you would have built zero equity in any type of a property. Okay. Owning a property gives you the benefits of building equity. It's going to give you the benefits of some tax breaks, as well as being able to do whatever you want with the house, right? If you're renting a property, your landlord more than likely is not going to allow you to, knock down a wall or redo the backyard or, even paint in a lot of cases. So owning is going to be a much better scenario for you. It's going to be overall cheaper once you factor in the tax benefits, but more importantly, it's helping you build wealth over the long term. So that's kind of our thing. I mean, if you've been renting for even longer, so there you're kind of, you can kind of just see what those numbers add up to. So our next slide here is our affordable product comparison. Sorry, I've got a pop-up that was in the way. And I just wanted to go over the different types of programs that are available to first-time home buyers, as well as some of these don't even apply to first-time home buyers. So you can have already been a homeowner and still take advantage of some of the programs. Some different options there is we've got our Home Possible and Home Ready. That program is going to be designed for low to moderate income. Okay, so when you see this on the left-hand side where it says product type and you're looking at the box here that says AMI. That basically is just your area median income. So depending on where you live, if your income is below 80% of that area median income, you would qualify for this program. So it's going to allow you to put down 3%, give you a credit score in most cases as low as a 620. We can go lower, but that's going to be a case by case basis. Both Fannie Mae and Freddie Mac have eliminated that 620 credit score requirement. So we do have some options to go lower, but it's all going to be based on what our automated underwriting system comes back with when we run through your information. If it tells us we can do it, then we can go ahead and do it. If it doesn't, we can, you may have to be subject to putting down a little bit more money to make that work. A couple of things on that program is you do have to take a home buyer class. And that class is generally a 20 to 30-minute class that's done online. Once you've completed that, then you're issued a certificate, and then that would just come back to us and you're put into within your underwriting file, which just means that you've gone through and kind of, at least you know what you're getting into when you're purchasing a home. All of these programs do allow for rate buy downs. So in a lot of cases, if you can negotiate with the seller to pay for your closing costs, you can use a portion of that credit to actually buy down your interest rate. And the good thing about all these programs that are on here, the loan level price adjustments, or the three at least that are for first-time home buyers or low to moderate income, have limited loan level price adjustments. Okay. What you're going to see there is if you were purchasing a property with just say 5% down, and we use our standard Freddie and Fannie program, your rate could be as high as 7% on a 30-year fixed. But using one of these three other options, your rate could be as low as 6.25%, which would be kind of the going market rate. So definitely some advantages there to anyone who falls into these categories, especially if you're a first-time home buyer.
All right. I have to look to the right because that is where my screen is. So if I'm not looking at the camera, that's why. We just provided a couple different examples of that area median income that Sam was just talking about, because it's going to be different depending upon where you live. And like we mentioned earlier, we are licensed in many states, and so we do see different things all over the country. And part of it is going to be, just based on what the area median income is when it comes to affordability. So we just pulled two different markets here, which is like the San Francisco, California area and the Tampa, Florida area. So because San Francisco has like this high cost area, we can also go to 120% on some programs of the area median income. And when we talk about area median income, a lot of the programs will allow us to not use some of the income. So if you're trying to qualify for some of these programs to get the better interest rate or a grant or anything like that, what's really great is that if you get bonus income, but I don't need it to qualify you, we can ignore it. We can't ignore a portion of it. We have to ignore all of it. But sometimes that just gives us the amount of income that we need to qualify for the mortgage, but then still be under these limits. If there's two of you on that are going to be purchasing the house together, they say, partners or a husband and wife or whatever it may be, then what is really also great is that if we don't need both the incomes to qualify and just using one of them makes it work for this, then we can do that as well. So a lot of it takes creativity, what the goals are, and then just us consulting you on what the best path is forward. Here are just some basic numbers that we pulled together based on some of those programs Sam had just mentioned. So Fannie Mae and Freddie Mac, that's who securitizes the loan in the secondary market. And with that, we have a lot of programs that come from it. And so just using this top with this Tampa area, and right now today, there isn't a huge difference in the interest rates. Sometimes the spread is much, much larger. Higher rates are typically the spread's a little bit more. So you might think that going from 6 1/8 to 6 3/8 isn't going to be a whole lot, but it is, a tank of gas or half a tank of gas, depending upon what kind of car you drive. So every little bit of savings does definitely add up. One other great thing about some of the first-time homebuyer products that we have is that you can put on a conforming conventional loan, you can put as little as 3% down. Like there's this myth that we've been busting for decades at this point that you have to have 20% down in order to do a conventional loan, and that's just not the case. And the conforming loan limit is now 832, 750, Sam, is that correct? Just went
That
up.
is correct. 832,
Okay.
750.
And with 3% down, that gets us to like what, roughly? You do some quick math for me. In theory,
I
you can
wasn't
do,
prepared for math.
sorry, he wasn't prepared for the math. In theory, you can do 3% down on a very large purchase. It's kind of amazing. You have to qualify for it, obviously. Debt to income ratio needs to be there and everything, but it is possible.
And that number is 807, 767.
Yeah, it's pretty
3%.
amazing. So anyway, we have a couple of other products where we're talking about area median income. And the one I kind of want to highlight is the one on the far right side where it says 50% AMI. So 50% of the area median income. Again, it's a lower number. We're focusing on the low to moderate income borrower here, or not utilizing all of the income to qualify if we don't need it. But with that, we have products that we actually can give you grant money on. They can tend to come in and out of the market just based on, grant money availability. The government is, renewing the product or making any changes or anything like that. But we do have them available now. So it's pretty exciting because you can put down as little as 1% of your own funds to be able to do some of these products. So I am going to flip it over to Sam to talk about that.
Yeah, so on a lot of our down payment assistance programs, you can get in with as little as 1% down of your own money and work on some different types of grants that we offer. A lot of the states that we do focus or work in offer state-specific grant programs, okay, that will usually work off of a 1% down payment, and then whatever grant would be looking to kind of complete that. You still need to get to a total of a 3% down payment overall, but a lot of these are going to be very beneficial in helping you have money for your down, as well as using a portion of that towards your closing costs. Okay. So those are going to be extremely beneficial. Some of them will have an option where the grant is going to be forgivable. Some you have to pay back on a monthly basis, and some would be what we would call a deferred grant, where when you either sell or refinance the property, whatever that original grant was has to be paid back at that time. And again, those are all going to be varying depending on where you're living and what programs are available. Within our family of companies here, we do have a program that will allow you to do 1% down with up to a $4,500 grant, depending on where your income falls in that area median income. But again, you're still going to have to come up, with at least the 3% down total, but you can use that grant towards that number as well. Then one of the other options that we have too, that's not necessarily a state grant or a company grant, is our Chenawa Fund. You can use this with FHA funds or an FHA program. You can receive up to 5% of the purchase price or appraised value to be used towards your down payment. Okay. It's only good for purchases. You do have to meet the minimum requirements set by them for your FICO score. No first-time home buyer requirements. So if you're in the market where you're moving up and you still need some assets, you can use it. And it's available in 49 out of the 50 states. And it does have some income limitations depending on the program that we will use to go along with it. But again, another great option for anyone who, needs that extra cash to help pay for the down payment, closing costs, even use it to buy down the interest rate if possible. The only drawback to this program is it does come with higher interest rates than some of the other options, but it does get you more money in some cases, and is definitely something that we can look at if needed.
All right. So if you were thinking about purchasing, or if you have a client who's thinking about purchasing for the first time, the best first step is to do the pre-approval. We look at the online application, credit verification, income, assets. Do we need to look at some of these unique products that we have? And then once we issue the pre-approval, it's very important to understand the distinction also between pre-approval and pre-qualification. A pre-qualification, a lot of the big banks will do, they don't really carry a lot of weight. Pre-approval, we've vetted the information. But once we've given that to you, we usually suggest to go ahead and take it a step further, provide your actual documentation, and we submit it to underwriting for what we call our power bid approval. And the reason why that is such a great step to take, other than the fact that it just is like peace of mind, is the fact that you can take it to a seller. Most markets right now are still a little bit more in favor of the seller just because we have a really low inventory in a lot of markets. So think about it. If you like a home, somebody else probably likes a home too and wants to put an offer in it, whether they're a first-time home buyer or an investor or something along those lines. And you want to be able to paint yourself in the best light possible. Now, one thing with the first-time home buyer, which is specific to what we're talking about today, is they don't have a home sale contingency. So not having a home sale contingency is great. But then when you say that I've already been through the underwriting process, now I just need appraisal, title, home insurance, and condo warranty if it's condo, then you have a seller who's like, oh, well, that's great. They've taken, some of the guesswork on whether or not they're actually going to get approved out of everything. And they're definitely a serious buyer. Like, now we're just going to look at accepting offers of people who have kind of eliminated some of the contingency pieces. So it's something that we highly, highly recommend. And, most of our clients actually do go through this process. And then coupled with that and with us calling the listing agent to just verify, like, you're a very solid buyer and everything. It's also very helpful when it comes to getting your offer accepted. And again, peace of mind, very big key thing. So also we have a little chart. We will get this sent out to everybody today. And it just kind of talks about some of the steps in the home buying process. So the getting pre-approved, getting your loan submitted to underwriting, and receiving your power bid approval. That's the point where you would find and make an offer on a home and work with your real estate agent to negotiate. And if you don't have a real estate agent that you're working with now, let us know. We're happy to refer you to somebody. Once your offer is accepted, you have your attorney review. Home inspection. I would say 99 out of 100 of our clients, like, they're going to do a home inspection. And then we do an appraisal. You get your mortgage commitment once your loan's through underwriting and the appraisal's in and everything looks good. You're actually, I would say, find your homeowner's insurance a lot earlier in the process. We'll have to change that because you want to get a quote. You want to make sure, the life of the roof is a really big thing. For those of you who joined us over the summer, we talked about insurance and roofs. So there's a lot of different things that go into you getting a home insurance quote. You get your clear to close. You go through your final walkthrough and close your loan and you move in. So it all sounds very simple when we outline it like this, but the part that we always really want to reiterate is just making sure you know your numbers at the beginning. Come to the professional who's going to run the numbers for you. No house payment is going to be the same from one house that you're looking at to another. Taxes are different. If you're looking at condos, HOA dues will definitely vary. So knowing your numbers and what you not just can qualify for, but also what you feel comfortable with is very important. And then just wanted to finish up here with check out our link tree. Upcoming webinars are always on there. We'll have another one coming in Q2. We have some other contests coming up that you can join us for as well virtually. And then there's usually some online and in-person stuff in there. But follow along with us on social and our link tree. And the next step is we'll email out some information to everybody. And also send the list of winners for the gift card giveaway. And thank you, everybody, for joining us today.
Thank you.